Good Saturday morning to you, and welcome to On the Mark, along with Mark Papa. I'm Gary Byron. Mark Papa is with Financial Resources Group out of Glastonbury. You can find them online at www.frplan, that's F as in Frank, rplan, frplan.com. I'm going to give you a phone number. Write it down and call it. If you can call it during the show. I prefer you call it right after the show. At the very least, call it the Monday, early part of next week. And you're going to be happy that you did. Put it that way. It's going to open your eyes. Things that you thought you knew, but you really didn't. 860-657-8380. I'll repeat that for you. 860-657-8380. And one other thing, he's got a YouTube channel. If you miss any part of this show, or in fact any of the other episodes that we've done, they're right there on his YouTube channel. Two ways you can get to that. You can go to YouTube and just type in the search field Mark Papa 5207. It's MarkPappa 5207. But there's also a link to his YouTube channel right on his website, frplan.com. If you missed any points of these calls to action, I'll repeat them at least a couple of more times before the show's over. Mark, good morning. Great to see you.
Hey, good morning, Gary. How are you?
Oh, I am peachy. Thanks for asking. How are you doing?
I'd say very good. And settling into summer. It's we're getting into the dog days of August, and I'm going to be heading out on vacation for a little bit, and take about 5 days off just to kind of decompress a little bit.
You just were on vacation with your son, right? Didn't you go to, where'd you go to? Martha's, Nantucket? Or?
It was the same place, Newport. They had a special that came through email, 20% off, so I just rebooked it for 5 days.
Taking your son?
No, in this case, not. I'm going all by myself just to sort of decompress. They have a spa. I'm just sort of hang out by the pool and just sort of relax a little bit.
Ain't nothing wrong with that. I could use something like that myself. Good for you, brother. I'm happy to hear that you're doing something for yourself. Surprisingly, people often don't do enough for themselves, and that's a shame.
Well, I couldn't agree more. At times you just need your own personal space. You need a mental break, and maybe you go to a spa. Maybe you walk around, but you need to kind of just decompress a bit and sort of not have to worry about anybody else. And my son is great, and we've done a lot together this summer. Well, we have plenty of things to do, but football will be starting for him, so it's not a good idea to pull him away from those beginning practices. So.
5 days is just enough. Do you be honest here, do you take your work with you if you're going away?
A little bit. I mean, I still have my email. Right, and I'm always there for emergencies. When you own your own business, it's just the way it goes.
Often it owns you, right? Folks, today we're talking about innovative ways to slash taxes, boost cash flow, and build lasting wealth, especially for high net worth folks who maybe even business owners. Mark is a seasoned tax strategist. And he's also a member of the Institute of Untaxable Wealth. Mark helps clients legally minimize taxes, improve their financial flow, and secure more for their families and their legacies. Mark, it's all, like I said, I'm always happy to have you here. I learned so much, and I'm sure a lot of people listening to this do as well.
Yeah, thank you, Gary. And I'm really happy to be here to talk about taxes. We have a tremendous opportunity with the One Big Beautiful Bill that just passed to help people maintain or keep their current taxes in brackets or lower brackets. Mainly, the reason I joined the Institute of Untaxable Wealth, in addition, I just formed a new LLC called Glastonbury Tax Advisors.
Oh, is this separate from Financial Tax Resource Group?
100% separate. So anything we talk about tax-related, although we do integrate that into our financial plans, tax sensitivity, tax management, making sure you stay, your RMDs are minimized. You don't, go into, remember we talked about the IRRMA, the IRMA, which is basically just a surtax on your Medicare. So those are things that we actually do sit down with people and talk about. We're not just there to talk about your money. We're not just telling you, hey, your portfolio is up, everything's great this year. We're not just here to say, oh, send in more money to the government, give more estimated payments. That's not what we're here to do. So one of the reasons I started Glastonbury Tax Advisors is throughout the tax season, I had people who came to me with irrevocable decisions. Those decisions were they had to sell a house that mom gifted to them back in the day. It was a smart move to protect it against Medicare. Their long-term care plan was to go on Medicaid. And, that's the way they planned it. And this is, even before the days of really having long-term care insurance, the people did that. And now all of a sudden, everyone's getting a big capital gain. More recently, I've had people sell commercial buildings that I'm working with on these tax strategies. I've had people sell Airbnbs, things that you can't really, again, once you pull the trigger, you make that decision, it's irrevocable. Now you're just dealing with, how do I mitigate a big tax bill? And there's very, very limited opportunity once that clock turns after 12/31 and you hit January 1st. It's too late. I could tell people, well, maybe you can both max out your 401ks at work, and that doesn't go over well usually because, I'm going to have less income this year. And then they have to spend whatever's left over after tax in their account. So there's really not a good way to do it. So we want to get way in front of these in front of this and make sure people are utilizing strategies that are vetted through tax lawyers and the IRS.
Wow, this sounds comprehensive. And I hear you use some cutting-edge tools there. Walk us through that.
Well, there's a few softwares that I use. So one, I'm affiliated with a firm called Tax Maverick. They're using AI actually to help decide what strategy works best. And what's really interesting, there's a few types of income that you have. W-2, which is for high wage earners, right? So W-2 is you're not self-employed. You work for a company. You're the envy of the family. You're making $500,000, $600,000, $700,000 a year. You probably get some stock options. You're an executive. You're climbing the corporate ranks. Maybe you work at a private equity firm, a hedge fund, but you don't get those individual tax deductions versus, let's say, a small business owner where there are different kinds of write-offs and tax deductions and different strategies that we can utilize to help them save money and increase cash flow. But even they qualify for these type of strategies because a lot of owners will get their deductions through their business, or they'll do what's called like an S-Corp election, but then they also pay themselves W-2. So what do they do personally sometimes? So there's so many different things that we can do. And then for those people that have capital gains tax, those are the folks that might have sold a stock in a panic when the market was crashing, or they're stuck in a stock that is way up and they can't sell it. So it's almost like your money's trapped. You can't even use your own money. So you might be, have a big gain in a stock in your account, but you're afraid to sell it because you're going to pay capital gains tax. That capital gains tax then hits all your ordinary income, your W-2s, your ordinary dividends, your bank interest, and puts you in a much higher tax bracket. So as sexy as it sounds to say the rich don't pay taxes, I hate to break it to you, they pay taxes. Now, for those who want to plan, you'll pay less in taxes, but at the end of the day, you're still going to pay something.
It's impressive stuff, Mark. But let's shift gears a little bit. There's another site that's connected to your expertise. Diversify My Stock.
Yes.
I'm sure you've heard of that. So how does that fit into the tax saving puzzle here?
Well, I actually bought the domain diversifymystock.com many years ago. I never really did anything with it up until recently. A year ago, and I'm going back, I went to this conference. It was for Astoria Advisors. It was like their symposium. It was in New York City. It was at the NASDAQ. And then I also got invited to a launch party for what's a product called GQQQ, which is the growth, growth at a reasonable price, designed, equally weighted kind of, NASDAQ 100 QQQ product. Okay. So I went there and I met a lot of people at that conference. I bumped into a gentleman who's a PhD out of Wharton. His name is Wes Gray. And he was telling me about this product that they had where if you have a big portfolio, and again, this is for accredited investors, so this is for people that have a tax trap portfolio. Tax trap means I can no longer tax harvest that account unless it's going to trigger a big tax bill. Okay, so tax loss harvesting is interesting. What we do is when somebody comes to me with a portfolio that's not in an IRA, 401k, or Roth, it's just a regular brokerage account or in a trust, whatever, I will have to go through, in order to raise cash for that client, I have to find these things called tax lots. I have to look for gains and losses. It's a tax managed account. So you have to be able to, what they call tax loss harvest, that account. And it almost has to be done on a daily basis, which is very cumbersome. But I'll get, for example, I had a client that wants to do geothermal. She needs 90 grand out of her account. How do I do that without triggering a big tax bill when she already has, lots of income coming in from dividends and interest? I had to go into the account, and you have to do a very detailed sell of those accounts to raise that $90,000. So if I just went in and say, okay, she's rich, who cares, let her pay the tax, and just figured find something that was, even if I did a sell what they call highest cost, she would still pay a big capital gain. And why would I want to do that? Because then in order to get that $90,000, I have to add back 23.5%. I have to sell more than $90,000 for her to get that geothermal. So just how much that just cost her, right? So you need to be tax aware. So what we go in and we sell off all the tax loss that have the losses to offset those gains. It's very difficult to do, and it's very cumbersome, but it's what we do. It's what I do. I've done it many times, and it's my job. However, it's better to not have to do that at all. So one of the things we can do is sometimes you'll find a portfolio that's somewhat lopsided. It's called an IRC 351 exchange. And it can't just be if someone has, let's say, 80% of their account is in Microsoft and 20 is a bunch of other stock. It won't work for the IRC 351. So there's specific rules, and on my website, I won't go through it today because no one's going to remember it. On my website, I will show you the compliant rules through the white paper that I'm developing. And the white paper is going to show you exactly how the IRC 351 works. But in essence, it doesn't work with cryptocurrency, by the way. It doesn't work with mutual funds, but it works for separately managed accounts, ETFs, and stocks. And again, the specific criteria you need to meet to get into it. But what it does is it takes that portfolio and it puts it into a newly created exchange-traded fund. And inside the exchange-traded fund, you can then sell inside the exchange-traded fund and diversify that account. Okay. Wow. And then not only that, all those cells that go through are not taxed, because what happens inside of a exchange traded fund is what's called a like kind exchange. So you're able to diversify that account maybe from 8 or 9 or 10 or 12 stocks that were somewhat concentrated and tax trapped to maybe 100 different stocks, and many of which have better prospects than the 12 that you own. So it's a really awesome product. Now, the downside is your cost basis on your portfolio gets transferred to the new ETF. So if you sell the ETF, there's a chance you could trigger a tax bill. But either way, it'll be at a long-term 15, you want to do that at a long-term rate of 15%. So that's one of the major reasons I set up Diversify My Stock is many, many people are not diversified. And so many of these accounts have, 1 or 2 positions that sort of dominate the portfolio. And using my tax strategies, Gary, I can help people offset those capital gains in addition to the IRC 351.
I see.
And create a tax loss to offset those capital gains so that they can either qualify for the 351 exchange or free up some capital that they can actually go out and spend. They can actually go out and use their money. A lot of times, and then the third thing you'll see is a lot of portfolio managers I see, I can't mention his name, but he's a very, very famous, and he's a fiduciary on television, and says that his interests are aligned with yours. And I look at those portfolios at tax time, and there's big capital gains that are getting generated in those portfolios. And I'm not talking about big portfolios of maybe, you need $500,000 to invest with them, but that's the gross. So even on like a $200,000 brokerage account, I saw like $18,000 in capital gains on that. That's expensive money because it's money that client's not using, and they're paying $18,000. Now they're going to pay 23.5% on that 18. So it's just extra tax. It's money that they're paying tax on they're not using.
This is not just about saving on taxes. I mean, it's about smarter investing. So who should really check this out?
Anybody with a non-qualified stock portfolio should really take a look and let us come in and analyze their non-qualified stock portfolios. We're talking about larger portfolios. You need, for the IRC 351, the original minimum was $1 million. We're down to $500,000 in order to do that. You need to be an accredited investor because it's a newly created entity. It has to be compliant. It is highly vetted, designed by PhDs, excellent tax lawyers out of Philadelphia. So we're not worried about that part, but it has to be SEC compliant in order to be launched. So it's very, 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 very detailed. However, we can help people with those tax trap portfolios that if the minute they sell anything, it's going to trigger a capital gain, and help them reduce or eliminate those capital gains, and also help them diversify their accounts and put them in a better position.
Very cool. Great. You are listening to On the Mark along with Mark Papa. I'm Gary Byron. You can find him online at www.frplan.com. Also, write this phone number down and make sure you call it 860-657-8380. Again, that's 860-657-8380. And by the way, in very short, just a few minutes from now, I'm going to tell you how you can obtain your free $100 gift card from Mark. It's believe me, you don't have to jump through hoops. There's no fire involved or underwater backflips neither. So it's pretty easy. I'm listening to this, Mark. I mean, this is really gold for listeners. So, I mean, you have any tips to how to get this started?
Well, I think what people need to do is just contact me. I have a new website, by the way, so it's the same website, same URL, frplan.com.
Okay, good.
It should launch. It should launch in the next week. However, it's going to have a lot more information. It's easier to use. It's more aesthetically appealing, easier to use on your phone. But get in contact with me for a 30-minute consultation. There's no sales in these consultations. It's all about
people think there's always an angle. You're trying to get business. You're trying to get my money. So I mean, you're trying to sell me. But explain that.
Yeah, I'm beyond the point of needing to sell anybody. I haven't sold anybody since 2014. And what I mean by that, in 2014, I went and got that specialized training for the full checklist. That full checklist does not sell a thing. All it does is ask questions of people, has conversations with people, gets people to tell me or discover benefits that they're owed that they're not aware of. We're there to talk about, like I mentioned, not to go off topic, but, we review your tax return. We do a mock tax return and show you where you're paying unnecessary taxes. That's money that you are giving to the government that you worked for your whole life. Now, if we're able to recapture $10, $20, $30, $40, $50,000 annually in taxes on some of those bigger portfolios, is that money you had to go out and work for? Or is that money we're just recapturing and helping you put back in your pocket?
Oh, that's yours.
That's your money. You're not legally obligated to give that to anybody. And what's happening is you have unscrupulous portfolio managers, unscrupulous advisors who can't give tax advice or don't care, ultimately. And we get the clients to say, well, why wasn't this shown to you? And they'll say, we don't really know. Well, I said, well, can your guy give tax advice? No. Does he talk to your CPA? Oh, they've never talked before. And you say to them, well, why do you think he hasn't reached out to your CPA? Does he get paid to do that? And they'll say, well, no. Yeah, actually, he doesn't. Yeah. If he doesn't get paid to do it, why do you think it's not happening? Then they'll eventually say something like, well, because so he can make more money. He's too busy. He's too busy making money. And then so what? But is he there working for? Who's he there to work for? Is he working for you, or who's he working for? And after many, many times and many different questions, I'll more or less say the guy's working for himself. He only cares about himself. He doesn't really care about us. Good schmoozer, though. So there's advisors out there like that. And then there's, again, good advisors that do this detailed work, okay? Mm-hmm. They do the detail. I think they're in the minority, not the majority. And again, most firms are designed for the firm to make money. So that firm I talked about before, I won't mention names, they're designed to make that firm money. They have investors, they have private equity investors. And the minute you take, by the way, I will be acquiring my firm through my partner, but I'm not taking outside capital or private equity.
You're talking about Financial Resources.
Financial Resources, yes. And the reason why I'm not taking outside equity, because the minute you take that money, it's blood money, you are now working for the man. I am there to work for my clients only. I'm not there to work for the man. And again, that's why I
commend you.
I also set up a separate entity for the tax strategies, because we have a golden opportunity right now with the One Big Beautiful Bill to utilize these tax strategies for folks that you might be selling a beach house, an investment property, a business property. You could be selling a business in and of itself. There's a strategy for that could dramatically reduce. If you have a good accountant, by the way, your accountant will show you how not to take that 5-year paycheck and pay ordinary income on the sale. Some of it would be treated. You want most of the sale of that property of that business to be treated as a long-term capital gain, so that you pay a much lower tax rate. However, you're still taking a salary from that business, let's say at $300,000 a year, and you sell your business for $2 million. All of a sudden, you can sell it over 5 years. You can sell it all at once. Bottom line is you have a big tax problem. So we want to make sure we can help you through those things, and that we have the strategies to do it.
So you've got Financial Resources Group in Glastonbury. Obviously, you do an incredible work on behalf of your clients, but you also have Glastonbury Tax Pro, and you can find them online at glasstaxpro.com.
And Tax Pro is the preparation part.
Yeah, I was going to say, do they work in tandem?
Well, okay, so here's the thing.
I know they're separate entities, but is there any overlap or any where one helps the other?
Yeah, all the time.
Is there benefits to that? What would they be?
I get all the tax questions at the firm, okay? And people will come to me and say, so-and-so is, and again, a lot of the clients that came to us didn't get the planning ahead. So now they're getting these big RMDs, which we're going to talk about in the next episode, that are crushing them. And then a spouse dies. We'll talk about this. Now they get what's called the widow's penalty. Now they go back to a single tax bracket, and they're getting not only that same amount of income from their IRA, the RMDs, they're getting hammered with that. Higher taxes on their Social Security, higher taxes on their income. And then now when they go to sell a property, by the way, what's happened to real estate prices recently in the last few years? Skyrocketed. So now they want to sell the house. Okay, maybe downsize, move to a smaller home. Now that house was purchased years ago. Now you can get half the cost basis of the first or the husband, but the husband died 10 years ago. Now all of a sudden you only have $250,000 exclusion to sell that house. Now you're selling the house for $500,000-$600,000. I mean, the Ray's Ranches are selling for $500,000-$600,000 in my neighborhood. Ray's Ranch is unrenovated, okay? But Grandma lived there. Now, all of a sudden, Grandma's got a $200,000 capital gain, all right? So what do you do with that? How do you get rid of that? And most people are saying, well, we're going to free up some money, and we're going to pay the government. We're going to pay the taxes and be good citizens. Or you can call me, and I'll figure out how to wipe out that capital gain for you.
I love it, Mark. I always learn something new from you. Always wise words from Mark Papa of the Institute of Untaxable Wealth. I got about 4 minutes, maybe 3.5 here. I know, of course, I want people to head to glasstaxpro.com or DEV.diversifymystock.com, right?
Yeah, that'll just be diversify, DIVERSIFY, my stock. The DEV is the development site. We're just putting the final touches on it. So,
okay.
But that's more for things like IRC 351, concentrated stock positions. So let's say a great example of that is I just inherited an account. A gentleman recently passed away, thankfully, for his beneficiaries. It's sad that he passed away. He was 86. He lived a great life. Wonderful guy. And he had 82% of his account, and there's nothing we could have done with it, in Microsoft. This Microsoft stock was bought many, many years ago.
Wow.
Microsoft stock, when I first inherited this account, it might have been somewhere near $1.2 million. That was like 3 years ago. It's now a $3 million account. I had to do a double take because we do look at the accounts, but I did a double take on it. And I'm like, whoa, wait a minute here. This account grew to $3 million because 82% of it was in Microsoft. Now, had his children not inherited that, they get a step up in basis on that. So if they wanted to liquidate it, the taxes would be not that big of a deal. If we sold it at Dad's cost basis, he would have probably like a $2.5 million, probably more, probably like a $2.8 million capital gain on that account. And there's nothing you can do. So, yeah, you can sell it and pay 15% in tax, but remember, you're going to pay the state of Connecticut too on that, 6.99%. So before you're done, you're looking at north of 23-something% on that you just had to pay the government just to go use your money. So not the most favorable thing to do. So what we look to do is figure out what people's problems are, where exactly we can help, and then we come in with a strategy. And sometimes it has to be done over time, and other times it can be done in a one-shot deal. But either way, finding a way to reduce that tax, knowing what you're facing. Half the problem is people don't even know what is in front of them. And I'm going to talk about that in the next episode. RMDs, required minimum distributions, the amount of money you lose in that $1 million 401k. Okay, you only really have, if you're just a normal person with two Social Security checks and $1 million in 401ks, you really only have somewhere in the neighborhood of $750,000 to retire.
Well,
because 25% of that's going to go to the government.
Yeah.
And any growth, over time. It's ugly.
Before I wrap things up, take about 30, 40 seconds. How can people obtain their free $100 gift card?
All right. First things first, they either give us a call at 860-657-8380, or on my new website, there's many, many opportunities, www.frplan.com, to go in and make an appointment. 30-minute consultation. That's what we call our goals meeting. We're going to find out what's the problem, and then we're going to talk about goals. We're going to ask you, would you like more income? Would you like to pay less in taxes? Would you, how much, do you want to make sure your money gets left to your beneficiaries correctly?
Right. Yeah, these
so we
are
have
common
it's
sense
the 5
questions,
simple questions, and we ask them on a scale of 1 to 5, the importance. Most people tell us each one is typically a 5. Because I'm also going to ask them things like in here, remember I talked about how to pay less than 1% on investment income, how to pay 70% less than IRA withdrawals. So those are the things that we have, that we also have in addition to some of the things I talked about.
That sounds like a 30-minute consultation, no obligation. You're going to walk away with a $100 gift card. Pretty cool. Folks, if you'd like more information on that gift card, and that's the small potatoes. The big, what Mark is going to be able to do for you far surpasses the $100 gift card. Check him out online at frplan.com or call him. Make that consultation today. 860-657-8380. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.